Every financial crisis is called an accident, a shock no one predicted, a failure of regulation, a mistake in judgment. But accidents don't repeat this precisely. Crashes arrive on schedule. Different decades, same pattern. Different countries, same outcome. So what if crises are not failures? What if they are a feature of the system itself? Modern finance promised stability, its endless growth through innovation, safety through diversification, protection through regulation. Central banks promise control. Economists promise prediction. Markets were said to self-correct. Risk was said to be manageable. Yet crises keep returning, and each one is larger than the last. Before modern finance, money was physical. Gold limited excess. Silver restricted expansion. Lending depended on real savings. Failure was immediate and visible. A bad loan ruined the lender. A bad harvest reduced spending. Growth was slow but grounded. Crises were local, not global. Then abstraction replaced reality. Banks learned to lend what they didn't have. Fractional reserve banking normalized leverage. Credit expanded faster than production. Central banks emerged as lenders of last resort. Money became policy-driven. Debt became fuel for growth. Expansion no longer needed savings. Limits were removed quietly. Stability became an assumption. Fragility was hidden underneath. Profit was privatized. Losses were delayed. Risk produced reward in good times. Failure was softened in bad times. Institutions grew too large to fail. Complexity protected responsibility. Models replaced common sense. Short-term gains outweighed long-term risk. Growth became mandatory, and crises became inevitable. Easy credit fuels expansion. Expansion fuels optimism. Optimism inflates asset prices. Rising prices justify more borrowing. Leverage multiplies exposure. Caution disappears during prosperity. Warnings are ignored. Risk hides inside success. Every boom stretches the system thinner, until one stress becomes fatal. A rate hike slows borrowing. A default breaks confidence. A shock exposes leverage. Liquidity evaporates instantly. Assets fall together. Correlations go to one. Debt becomes unpayable. Trust collapses faster than prices. Panic replaces optimism. The system snaps under its own weight. Governments step in immediately. Markets are frozen. Trading halts. Bailouts are announced. Central banks print money. Emergency powers expand. Rules are rewritten overnight. Failure is no longer allowed. Survival becomes the priority. The system is saved again. Workers lose jobs first. Savings lose purchasing power. Small businesses collapse permanently. Housing becomes unreachable. Asset owners recover fastest. Wealth concentrates upward. Public debt explodes. Future taxpayers inherit the burden. Trust in institutions weakens. Inequality becomes structural. Regulations follow panic, not prevention. Loopholes replace old rules. Complexity increases again. Incentives remain untouched. Debt stays central to growth. The cycle quietly resets. Today, global debt exceeds global output. Crises are postponed, not prevented. Takeaway 1. Crises come from incentives, not mistakes. Takeaway 2. Stability without limits creates fragility. Takeaway 3. Systems that remove failure eventually fail bigger. Money works only while trust survives. And trust breaks faster each time. Subscribe to understand money before the next crisis arrives.